Life moves fast, and so does your career. You've built a successful path, but now it's time to diversify your investments and secure your financial future. Introducing The Prestige, your trustworthy, vetted partner in commercial real estate investing. We understand that you're time-starved with a family to care for and a demanding career to navigate, not only sheltering, but safely multiplying your returns in a hard asset, which does not walk away. You can drive by it anytime. At The Prestige, we specialize in serving professionals like you who seek safe and secure investments without the burden of becoming an expert in commercial real estate. With over 400 years of combined experience, our team of seasoned experts is here to guide you towards high return, high yield investments in a low yield market. We meticulously analyze market trends, assess potential risks, and identify lucrative opportunities, ensuring your investment portfolio is optimized for growth and stability. Here's a few of our client testimonials. Wow, DL, this is so exciting. I'm so happy for you and for us. Very exciting, and love the floor plans. We've got our distribution pending in our bank account. Thank you so much, DL. DL, we can set our watch to your distributions. Never missed a payment. Don't let time constraints hold you back from maximizing your investments. Visit The Prestige at mayhill.com today for our current and rare investment opportunity, and let us leverage our expertise to secure your future. DL began in commercial real estate in 2005 and is one of the top seasoned leaders in investing and developing in Southern California and Dallas, Texas. And there is no slowing down. The Prestige, your partner in commercial real estate investing.
Good afternoon, everyone. Looks like everybody's coming in. Good. Thank you for being on time. This is great. Okay, good. So we're ready to. Hello, everybody. If you want to put where you're calling from in the chat for us. We're in Dallas, and we were able to dig out yesterday, which is unusual, but a couple of years ago we did have the snowvid, right? And thank goodness our properties are on a good grid by a fire station and by the hospital district. So everything is good there. So a lot of sun this afternoon. I think it's going to be 45, which is a beautiful, beautiful day when things start melting. So we're good here. We're all good. And thanks for being on time. Not sure how many folks are dug out where they are, but I think we're kind of between storms, which is nice. And, people are moving around a bit and getting caught up, and we're ready. We're going to talk today about which asset class is half as risky as the stock market. We have a number of assets that we can invest in for asset allocation, and a few of our partners are looking at that, and that's the place where we need to be focused is asset allocation. So we've talked about that on some of our meetings as well. I'm DL Campbell. I own these properties, and we like to do these knowledge sharing sessions so that we can equip our partners and people who are looking at the opportunity so that you all have the best training and tools to make great decisions. So this is part of this lunch and learn. We'll probably work for about 30 minutes. So let's put some work in. And then I want to honor your lunchtime if you're on lunch. So if we're ready, are we recording, Rochelle?
Yes, DL.
Good. Rochelle is in our finance department. I'm sure y'all had talked with her as well. So she was a great help with that finance degree. We put her to work. Okay, so let me see. I'm not a Zoom expert, but we're going to share screen and start a little presentation. And I really am very interested in this. Am I sharing my screen? Not yet. Try again. How's that? Slideshow from beginning. It looks like I'm sharing my screen. Rochelle, can you hear me?
Yes, DL. Loud and clear.
Alrighty then, let's go. So again, Honors Way Group, we're commercial real estate investor developers in Dallas, Texas, and we are very excited about the projects that we're working on, but this is our niche. I have 20 years of commercial real estate experience, former engineer, accounting at a CPA level, and so all kinds of good background to come into this commercial real estate investment arena. And frankly, I came across commercial real estate investment when I was looking at different asset classes to work on 20 years ago. As an engineer, my clients were Lockheed Martin, Northrop Grumman. I worked for the generals in the Army. And so, pretty interesting career. I've been everywhere in the world. I've worked everywhere. So, interesting career. But I noticed, like they say, my ladder was leaned up against the wrong wall. And so, while I had my excellent career, I started looking at commercial real estate in all different asset classes. What suits me best? And so, I found commercial real estate really is very logical and consistent, and you can make a lot of money with it. It's a team sport. It's not something to just pick up and do one day. I didn't do that. I actually set a goal, and you probably want to set a goal too. What is your goal in investing? Do you want to double your income in cash flow? Or do you want to replace your income in cash flow? What is your goal for this retirement phase? So we need to look at that, right? It's good. So, I've been a vetted teacher for Quest IRA. It was a big custodian that was purchased by Inspira. And so it was a great company, very successful, and it was acquired by Inspira, one of our custodians. We work with about 15 custodians. And so I've been a vetted teacher for commercial real estate and due diligence for Quest, doing lunch and learns. I have over $350 million in transactional history in commercial real estate. I've never done, we've spoken and worked with TNDDA, ADISA, FactRight, all of the investing due diligence firms. We've spoken at investment clubs, and these are advisors. These are actually advisors. And who's this? We know this guy. He's very nice, by the way, very approachable, and he's a good speaker. So here's a good disclaimer and confidentiality, but here's also our property in Austin, the common area in Austin, 22 North, and you can look that up as in our track record. Quick meet the team. You've met me. Kobe Hanai is, try that again. Kobe Hanai is a developer with about 30 years of construction management, and he has built and sold over 1,500 developments in townhomes. He's updated, rehabbed 3 commercial multifamily. Warren, you probably met him when we go and speak as well, but he is our director of development services, over 30 years, and planning for big cities, Tampa and Dallas. And then Mike Carrasco, I've worked with Carrasco for about 17 years, and he has a big development background as well as being a commercial real estate mortgage broker and due diligence. So we're going to slow it down a bit. And this is our focus. We're going to talk about different assets in your portfolio. And I have found this very interesting, really, to carve out the time and talk about asset allocation. If you're working with a registered investment advisor who is registered under FINRA or hangs their shingle under a licensed broker dealer with a Series 7, and then they're also going to direct you in this path of asset allocation. And in fact, we were working with one of our partners who was working on his portfolio, and he was looking at his diversification. We had a great conversation about that actually, as we looked at some of the things he was working on and already in. And so we found that one of the companies he was looking at was heavy into energy, and that could very well be. It could be that that's their niche. Like, we're heavy into commercial real estate because that's our niche. I've worked on all kinds of asset classes: retail, value engineering, industrial development. But that is our niche, is real estate. And the advisors are actually looking at putting 30% of your portfolio into commercial real estate. If you don't know the industry very well, I think that's a good position to have. Or if you don't know the team very well, I think that's a good position to have. If we look at the stock market, and we have a ton of people coming out of the stock market right now, they have a little bit of a knee-jerk reaction where they have been watching the stock market all the time. And so their adrenaline is always up all the time. And that is a cadence that they're in. The muscle memory, the neural pathways are working that way as well. And so they always have to be on. So they're learning how to be a little bit more passive and learn about the market, learn about the commercial real estate market. We have over 200 YouTubes that you can watch and put that into your tool belt. But if we look at that volatility, commercial real estate is half as risky as the stock market. So half as risky, and it doesn't walk away. So commercial real estate doesn't walk away. You can drive by it. It's still going to be there. It is not, there's not no risk to commercial real estate. And we'll talk about how to be safe inside of a real estate investment and how to vet these syndicators. I own the properties. We're not syndicators. So the other thing about the stock market is, of course, we know that if the government does something, then watch out. If some party somewhere does something, there's some civil unrest, stock market takes a toll. So you can make money on the volatility of the stock market if you're a day trader, but there is this point where there is too much risk and too much stress on our health, we'll say. There's a risk of liquidity. You can make a lot of money, but it has its ups and downs. One of the things about the stock market versus crypto or Bitcoin is there's a history to it. There are all kinds of tools that manage the risk, etc. But it's complex, and then you have, the government that could be involved in your business just because of the way that the stock market reacts to civil unrest. Now, if we look at crypto or Bitcoin, in the 1970s, that was the time to get into Bitcoin when it was cheap. And you could buy Bitcoin at you could buy a little bit of Bitcoin. And the way that the money was made in Bitcoin is it's not transactional. It's not buying goods or services. It is not even adding value to a market in any way, shape, or form. It's kind of like a Ponzi scheme. So you buy your little bit of Bitcoin, and then the next guy pays you. MLM, what is it? Multi-level marketing or a Ponzi scheme, where the only way that this Bitcoin can make money is by selling it to the next fool. So, there is going to be a last fool, and now Bitcoin is so expensive that, there's no sense in it. I think everybody knows that because it's been around for a while. There's a little bit of history there. There was only 21 million, I think, made of Bitcoin. Now we have this crypto thing. They're saying that it can't be regulated. The can't get it. The can't get it. Now it's regulated. Bitcoin, now it's regulated. Can't be stolen. Now it can be stolen. Anything online can be stolen. But the thing about crypto is that there's no track record. We really know nothing about it. And it's more about the speculation. It's not a of, this is a safe bet. Even this is a safe bet. This is a safe bet. It is more of that spike, the adrenaline spike, where you can make a lot of money. I think could, but there's such high volatility, and there's nothing known about crypto. Nobody knows anything. I have a partner that we're working with who's been waiting for this, I don't know, surge or whatever they call it in crypto since November. Oh, we think it's going to peak. That's right. We think it's going to peak mid-November, but it's very speculative. They're basing their judgment on high risk, and I hope they don't lose money. I hope so. Now, let's look at the energy sector. This is an alternative asset that a financial advisor would use in putting into part of your portfolio. There are a lot of times that oil wells don't hit or they're dry. So we don't have that certainty that there's going to be profit. It's very volatile. Oil and gas is very volatile. And the supply and demand a lot of time just doesn't balance out. There's not enough supply, low inventory levels. Now they've got fracking that they can drill a different way and try to go back into those old wells and redig. So that's a great way to do that. But still there's a high risk of those wells not hitting. And so if we're looking at the portfolio of oil and gas, energy, solar power, algae power, all of those things fall into this energy sector. So there is a certain level of your portfolio that could go in there, but it's a high and maybe medium to low reward, depending on the company and depending on the sector. So if we want to balance out, then we want to be able to look at the company's track record. Now, this is something that has been around for a while, right? We can look at companies' track records. We can pull up the reports of the in-ground asset and look to see what might be in those wells. And that's why advisors will put some of that portfolio into oil and gas or solar or any kind of energy. Tech is new alternative asset that advisors are getting into portfolios. But let's look at the risks of commercial real estate, because we really want to go through those. We talk a lot in our meetings about commercial real estate risks because there's people involved that are doing these deals, and they're syndicators. Those advisors get a fee. An advisor will get a 1% to 2% fee of what they manage for you. A broker dealer will get a 7% fee. But the syndicators, who are the regular Joe who's gotten into commercial real estate, they get a fee for closing that loan from you and bringing capital into the project. That's one part that makes it risky, because what is their purpose? Their purpose is to close the deal so they can get a little fee. Do they have the experience? Do they own the property? Sometimes they'll just get into a contract on the property and not even have control over the property. So there's no collateral yet. We have to watch that. Do they own the property, or do they just have maybe LOI, a letter of intent, or a contract on the property, and they don't even have control yet? High initial costs, and that's where I'm saying, this is a team sport. We're not going to go into a multi-million-dollar project without having a team. We have 400 years of commercial real estate and construction experience, 400 years. So it's a team sport. Market volatility, and that really is a decision on which asset class within the commercial real estate realm that we work with. during the pandemic, which was a great stress test. As an engineer, I would call it a great stress test now that we're out of it and can look back on it. A global, international, multicultural stress test. But what we found in 22 North, our Austin property, was that while all the rest of the nation was going through rent moratoriums, our tenants just paid their rent. They're 30-something professionals. They are just focused on building their career and paying their rent. They're not sitting around in a B or C class property thinking, gosh, how am I not going to pay my rent this month? So we were able to see that high success rate in our market volatility stress test. And so we're sticking with the Class A luxury when we're talking about multifamily and we're talking about condominiums. So excellent. We actually have in Dallas is about 3 times better a market than Austin even. So that was a great surprise, and we're excited. We're going to go into our property, and a lot of great things are happening there as well. Very, very exciting. Extended vacancy periods. Well, look at 22 North and the pandemic. Look at the rent moratorium. And look at all of the Class B and Class C properties that the people just didn't pay their rent. And eventually the government came in and they did rent help, rent assistance. But we only saw rent specials on 22 North one time during the pandemic. That's really good. For Texas, it was about a year, but for other states, it was a couple years. So we want to make sure that within this commercial real estate realm that we're sticking right with the best asset class, which is recession proof. It's recession proof. And so that's one of the reasons we've kept with the Class A luxury condos and multifamily. Here's another place where it's a team sport. We have to have that capital stack on number 4. We have to have the capital stack built up. So the first part of that capital stack could be private money, could be my coming in with over $1 million. It could be friends and family, could be people that we meet and have meetings with. That first part of the capital stack. And when Carrasco and I set up the property, the Prestige at Mayhill, we actually determined how much private money we could bring in without overpaying for money. And it ended up to be very flexible because look what happened to the interest rates. They were too high for a while. And so we just continued to bring partnerships in and give away equity and bring in private money. And we've tripled the value of our property. It was very flexible and we could put it right into the property. We took a $6 million property off market that had a valuation of $9 million when we bought it. We put entitlements in it. It was worth $13 million in the feasibility study. And we put the permit and the plat on it. It's worth $19 million. So we have a lot of equity there to attach to. Let's talk about the worst case scenario. What is the case scenario that could happen to my money, right? This is your money that we're talking about. What's the worst case scenario? Well, I could graduate to heaven early. What would that day look like? I've got that equity. Our people would be paid out their principal, and then they would get paid their pro rata share of the equity, $19 million. We have $14 million of equity today. That's not talking about the future equity that we're building. It's a $220 million asset. But we're talking about today, what is the risk mitigation? And that's that equity piece. I love a good cooperative working relationship, but I love equity better. That takes a risk out of it, guys. Okay, well, you know what? I think that we've talked and logically about the different asset classes, and I'm glad that we're carving out some time at lunch to be talking about asset allocation, portfolio, and the advantages and disadvantages of these alternative assets. And so let's move to something that we love, and is working so well. We tripled the value in a couple years. Here we talked about 22 North, and here's a little bit of information. Let me check my time. Okay, good. So we can roll through these couple slides a little bit quickly. You can always get back with us at morefreedom.com or 817-409-8795, 817-409-8795 if you would like to learn more about what we're doing, if we can help you in any way. Here is our property that I'm talking about, not only survived the pandemic, but thrived. And it's a Class A luxury multifamily on 11 acres, built on 11 acres. It's actually 11 acres, 240 units, Class A luxury. So that tenant type is the 30-something professional. They're just building their career and paying their rent on the side. Same thing with our Dallas property, concierge services. That's what those tenants want, and they just always pay their rent. Corinth Living Condo. So this is a property that the advisors have asked for specifically. We're not having any private investors in this property, but it's 60 units, mixed use on property that I already own. So we have the collateral, and it is 30 condos and 30 multifamily for age 55 plus. We're excited about that. So when we're working with FactRight and MICLA and all of these due diligence firms, TNDDA, ADISA, we're always in front of attorneys. We're always in front of licensed broker dealers and advisors under FEMA, advisors under FINRA, vetting us all the time. We love that because we want people to be their due diligence. Think about a property that has a capital call or can't pay its own bills if it's a Class C or Class B conversion, a Class B or Class C conversion, and it can't pay its own bills, then there's a capital call that happens. And that means that the investors are called up, hey, property's not performing, we need you to put in more money or you're going to be diluted. So that's never happened to us, but that's what's happening on these Class C and Class B conversions. Okay, so we're in front of them. We love the fact that they're doing due diligence on these deals, and we are completely transparent. If you've seen the deal room, you know, lots and lots of documents that you can do your research on. So I'm excited about this. This is going to be fun. 55 plus. This demographic is a great demographic for pride of ownership. They don't party a lot. You know, it's a great demographic. So this is our apartment building. This is the Prestige at May Hill, 350 Class A++ or Class A luxury units for 30-something professionals. And we're very excited. We're just weeks away, very close to getting that grading permit approved. I think we'll know in the next couple of weeks that that's completely approved. We've got all of our documentation into the city for that, but we've de-risked this project because we have our permit. Now everybody wants to give us money and do our construction loan. We've got that medium part of the capital stack, the mezzanine financing. We've got that lined up in a number of ways. We've got the construction loan lined up in a number of ways as well, and at a decent rate. By raising some private money along the way, we've pushed forward with that permit and all of the requirements the city has, and we've de-risked the project based on the status of the project. And it's a big boulder downhill, and it won't be stopped. Everybody, it really easy to bring money to this project. So we closed it off for unaccredited investors, and we've set a lower limit of 250. So we're about to have this fund fully subscribed. It's exciting. Here's some of the numbers and the bottom line about how to evaluate a commercial property is not cap rate. There are a number of factors that we need to consider: market, submarket, demographic, rents, a lot of different things. Of course, we've done all of the analytics, but the biggest determining factor is NOI. And what is NOI? Net operating income. So this is a yearly NOI, a yearly net operating income. You can see that this is not a Class B conversion or a Class C conversion, because the summary is, what can it produce? What can it produce? A lot of information here, but also in the deal room as well. And if you want a copy of these slides, just let us know. We've got some great renderings. We have a local veteran artist, a disabled veteran, who has painted some special oils for us in the entryway for each of the 9 buildings. And he has done a special oil. He did the oil that's behind me, and there's another oil behind the banner, but he's one for the office and then one for each of the entryways and the apartments. And we actually have 9 in the Prestige at Mayhill, the 350 units, which is nice because you take a look at that income, it is coming in by building. So when we get the keys, we will have pre-leased that apartment building 6 months ahead. And we'll have those deposits coming in, and we'll have the people coming in, but we don't have to build 350 units in a wrap style. We'll get the keys, and we will have pre-leased that building 6 months in advance. And the income will start accumulating and getting bigger and bigger. That's a nice thing for your financial statement. Little community area that they can do some collaboration, bring their laptop and work in there. Beautiful. And it's that 30-something lifestyle that we're attracting. We also have another income source. So it's part of the profits that we are sharing with our partners. And this fund, I believe Fund 3 is going to be fully subscribed pretty quickly here in the next couple weeks. But think about getting some income off of this grab and go when somebody has a popcorn emergency or they need a Diet Coke. Hey, studying late, I need a Diet Coke. And you get some of that income. Common area looks like 22 North, and we're leveraging a lot of that engineering, architectural design, interior design, and exterior design. We're leveraging all the work that we did from 22 North. We have an influencer room, and we have a fitness room that should be excellent for this 30-something tenant type. And this influencer room is where they can go in there and make the influencer videos, pull down a screen, have a little sound system. It's pretty cool. We also have a floor on the amenity building, a 2-bedroom condo where investors can come and look at the area, fall in love with the properties, and check on their investments so they could come and stay a couple times a year. So I think it's just gorgeous. It's just beautiful. And these are, I didn't ask our construction for a lot of overpriced things, but I am really loving these fireplaces here that are just gorgeous, because look at the views. If we look out of the balcony there, that is actually looking out onto our tree section, and walk through the trees. And also there's a 9-hole golf course. And who owns that property? Jerry Jones. Everybody knows Jerry Jones of the Cowboys. He owns the property next door. So, think about coming to the investor loft, staying a couple nights, falling in love with the area. And I just think these will be gorgeous. A see-through fireplace and a big deck to get out on. Okay, so we also have a hot sauna on the fitness room and a cold plunge. We have room for 400 mailboxes, and also more more profit centers. So we have income that's generated from the wash and fold laundry. They have their dry cleaning that they want to pick up the next day, we'll have that done. We'll have that taken out. If they want to have their lettuce put away in the refrigerator, concierge services, and we'll be able to help them out with some extra concierge service fees as well. Covered parking, dog rents, pet rents, billboard rents, and those are some of the centers that we share with our partners. Why multifamily? I think we're getting to the end, but get a copy of these slides. We also have all of this documentation in the deal room, right at the 35, and some of the nice shopping about 3 miles away. Very nice area. We looked at the numbers. We have a webinar that's coming up on March 11th, and if you would like to get registered for that, let our team know. Register for that now. It'll be at noon on March 11th, which I think is a Wednesday. And we're going to be talking to advisors about how to avoid real estate pitfalls. Because if you think about the syndicators and how they've messed up the market, I just had to bury my head into my properties and triple the value and do my job. But man, they messed up the market. And think about that. From an advisor standpoint, it tarnishes their reputation if there was a capital call in that advisor's book. So we're talking to advisors about how to avoid some of those pitfalls. And we do education for advisors as well when we travel and speak. So if you'd like to be a part of that, it'll be a free webinar as well. And we'll be talking to advisors mostly there, but we want to know what they're learning. So I'm going to, let's see, try to be a Zoom expert. Let's PowerPoint. We have our deal room that you can have access to. We have our funds that we have brought in. We have about 85 investors, and 75% of them have come in 3 times. We have our honors youtube.com that has over 200 real estate videos and talk about knowledge sharing. We're talking about all of this good stuff that we've talked about from an engineer, owner, developer perspective, but also we've had guests, like one of our favorite custodians has on a YouTube with us, and we talk about recession-proof assets. We talk about how to set up your IRA, and so we're just all over the internet. We'll have a frequently asked questions page on our website at theprestigeatmayhill.com. We've got floor plans and amenities and everything, a good gallery, and some answers to some frequently asked questions. Are their underwriting assumptions conservative? Yes, in many areas. There's a typo there we'll have to fix. In many areas. For example, the vacancy rate is set at 7%. That's how the bank wants to see that vacancy rate. Even though the Dallas market over the last 16 years I've been here is 2 or 3%, we still want to put 7% vacancy factor in as risk mitigation. Back to the numbers, risk mitigation to protect everybody. What fees are charged by the sponsor? We talked about fees being more related to syndicators and why they get those fees when they close a loan. And what happens with our partners when they close a loan? Well, it gets deployed, that capital gets deployed immediately, put some labor to it, and it increases the equity even more. So the capital is deployed immediately into the property. If you want to go through some of the frequently asked questions, that is a great place to start, or some videos. And Rochelle, I think we're wrapping it up here. Let me go ahead and stop sharing. Okay, good. Well, I appreciate you all attending today. Thank you. Good to see you all. And if you have more questions, feel free to get back with the team and with Rochelle, and we can get those questions answered for you. Thank you all. Have a blessed day.
lifetime of hard work and dedication. It's time to enjoy the fruits of your labor. As you enter into retirement, securing your nest egg and preserving your financial future becomes paramount. Not only sheltering, but safely multiplying your returns in a hard asset, which does not walk away. You can drive by it anytime. Introducing The Prestige, your trustworthy, vetted partner in commercial real estate investing. We understand that you seek less risk, financial security, and a reliable source of income. With over 400 years of combined experience and proven track records, The Prestige is your beacon of trust. We specialize in providing safe and secure investment opportunities tailored to your retirement goals. We know that you need to rely on experts to navigate the complexities of the market. That's why our team of seasoned experts is here to guide you every step of the way. Our collateral contracts have been approved 10 plus times by Quest IRA, which is under the SEC. Here are just a few of our client testimonials. Wow, DL, this is so exciting. I'm so happy for you and for us. Very exciting. Love the floor plans. We've got our distribution pending in our bank account. Thanks so much, DL. DL, we can set our watch to your distributions. Never missed a payment. Don't compromise on your retirement dreams. Visit The Prestige at mayhill.com today for our current and rare investment opportunities. And let us utilize our 400 plus years of experience to safeguard your nest egg and provide you with a secure investment in a low yield market. We are owner operators with daily hands-on on-site responsibilities. We are not syndicators. DL began in commercial real estate in 2005 and is one of the top seasoned leaders in investing and developing in Southern California and Dallas, Texas. And there is no slowing down. The Prestige, your trusted partner in commercial real estate investing for retirees.